The planes are flying. The skies above Africa are busier than they have been in years. Runways hum, terminals fill, routes multiply, and yet the money does not move. Across the continent, aircraft lift off on schedule, carrying passengers, cargo, and promise. But on the ground, billions in airline revenue remain trapped, frozen behind capital controls, administrative barriers, and financial bottlenecks. Growth is visible, freedom is not. This is the contradiction at the heart of African aviation today. More flights, but less control. More passengers, but tighter constraints. More movement in the air, while the lifeblood of the industry is held still. For airlines, this is not an abstract accounting problem. Without access to their own earnings, maintenance is delayed, expansion is paused, and the investment decisions are quietly shelved. For workers, it means uncertainty. For economies, it means missed connections, literal and strategic. Because aviation has never been just about aircraft. It is about sovereignty, about who controls the flow of people, of trade, of capital. When money cannot return home, wings alone are not enough. Stay with us. This story is not about planes. It is about power, control, and the price of flying without financial freedom. And as the engines continue to roar above African skies, a deeper question waits on the runway below. The story does not begin with crisis. It begins with momentum. Across Africa, aviation is growing. New routes are announced, regional hubs pulse with movement. Aircraft arrive fuller than before, lifting families, traders, students, and ambitions into the sky. From the outside, it looks like progress at cruising altitude. Engines are running, schedules are packed, the skies are open. Yet beneath this visible ascent lies a quieter reality, one that does not show up on departure boards or glossy route maps. While planes fly forward, money stands still. Across multiple African markets, airline revenues generated locally are unable to return home. Earnings from ticket sales and cargo operations remain locked inside national financial systems, caught in layers of capital controls, foreign exchange shortages, and administrative delays. The planes move, the cash does not. This is not a technical failure, it is a structural one. Airlines operate on tight margins, fuel, maintenance, leasing, insurance, training, none of it waits patiently. When revenue cannot be accessed, every decision becomes heavier. Fleet expansion is postponed. Maintenance schedules stretch. New routes, once announced with confidence, are quietly reconsidered. In boardrooms, growth charts point upward. In finance departments, warning lights blink. The contradiction is stark. African aviation is expanding in reach, yet constrained in freedom. The industry is asked to perform like a global connector, while being treated like a domestic utility, subject to restrictions that ignore how international aviation actually works. This tension is not evenly distributed. It concentrates where currencies are fragile, where foreign exchange reserves are thin, and where governments face difficult trade-offs between stabilizing national finances and honoring international commercial obligations. In those moments, airline revenue becomes a convenient anchor. Money already earned, already inside the system, already waiting. From a policy perspective, the logic appears defensible. Protect the currency, preserve reserves, maintain control. From the runway, it feels very different. Airlines are not vaults. They are circulatory systems. They depend on movement, of aircraft, of people, of capital. When one part is immobilized, the entire body weakens. The impact ripples outward. Suppliers wait longer to be paid. Aircraft lessors grow cautious. Insurers reassess risk. Partners hesitate. For passengers, the effects arrive quietly at first. Fewer frequencies, higher fares, longer layovers. Routes that once connected neighboring capitals now require detours through distant hubs. Connectivity erodes not with a bang, but with a slow, grinding friction. And still the planes keep flying. This is what makes the moment deceptive. The industry appears resilient because it continues to operate. But resilience under constraint is not the same as sustainability under freedom. What looks like endurance may, in fact, be deferred cost. Aviation, after all, is not just about movement through air, it is about movement through systems, financial, regulatory, political. When those systems fall out of alignment, flight becomes an illusion of a progress. In this environment, growth carries a hidden price. Every additional route increases exposure. Every new passenger adds to revenue that may never be fully usable. Expansion, once a sign of strength, begins to resemble risk. The metaphor is unavoidable. The runway is open. The engines are ready, but the brakes are still on. This is not merely an airline problem. It is a development question. Air connectivity shapes trade, tourism, investment, and regional integration. When airlines are constrained, economies feel it. When routes shrink, opportunities narrow. When confidence fades, capital looks elsewhere. What is unfolding in African aviation is therefore not a sectoral anomaly. It is a window into a deeper issue, the gap between operational growth and financial sovereignty. Because true connectivity is not measured only by kilometers flown, it is measured by control, by access, by the ability to turn movement into value. And as more aircraft line up on African runways, one uncomfortable truth becomes harder to ignore. Flying forward means little if the rewards cannot follow. But the most consequential question has yet to be asked. If money has become the new border, who decided where that border lies? The pressure does not arrive all at once. It accumulates. At first, it appears as a delay, paperwork moving slowly through financial ministries, approvals waiting on signatures, currency requests queued behind more urgent national priorities. Then the delays stretch, weeks turn into months. Numbers on balance sheets grow larger, heavier, harder to ignore. And gradually, the truth settles in. The money is not just late, it is stuck. This is the moment when growth collides with control. Across parts of the continent, governments facing foreign exchange shortages tighten their grip. Capital controls harden. Repatriation processes grow more complex. What began as temporary safeguards evolve into structural barriers. For policymakers, the objective is stability. For airlines, the effect is suffocation. Because aviation is unforgiving of uncertainty. Fuel suppliers expect payment on time. Aircraft lessors do not wait. Maintenance schedules are not negotiable. Insurance premiums do not pause for policy debates. When access to revenue is restricted, airlines are forced into a defensive posture. Cash buffers shrink. Credit lines strain. Decisions once made with confidence are revisited with caution. Every new route proposal is weighed not against demand, but against liquidity risk. The response is immediate, even if it is rarely announced. Frequencies are trimmed. Expansion plans are delayed. Hiring slows. Training budgets tighten. From the outside, passengers still see planes at the gate. Inside the industry, a different picture emerges. One of quiet recalibration, of ambition held back by invisible walls. International observers begin to take note. Industry bodies warn that blocked funds threaten connectivity. Partners raise concerns in measured language. Diplomats frame the issue as a matter of commercial confidence rather than confrontation. No one wants to escalate. Everyone understands the sensitivity. Yet the tension grows. Airlines are global by design. Their costs are denominated across borders. Their obligations are international. Treating their revenue as immobile contradicts the very logic that allows them to function. Here, the contradiction sharpens into a fault line. Governments argue that extraordinary times require extraordinary measures. Airlines counter that extraordinary constraints will produce ordinary outcomes. Fewer flights, higher fares, weaker networks. Both positions exist in parallel, rarely meeting, slowly drifting apart. And the consequences do not remain confined to balance sheets. Passengers begin to feel it next. Prices creep upward. Direct routes disappear. Journeys that once took hours now require detours through distant hubs. Regional integration, the promise of a connected continent, softens around the edges. What is lost is not just convenience, it is trust. Trust that tickets bought today will support services tomorrow. Trust that investment will be rewarded, not trapped. Trust that growth will be met with openness, not restriction. Behind closed doors, risk assessments are rewritten. Aircraft lessors reconsider exposure. Insurers quietly adjust premiums. Potential investors pause. Not because demand is lacking, but because predictability is. This is how aviation pressure translates into geopolitical signal. Markets do not respond to rhetoric. They respond to flow. When flow is interrupted, capital learns quickly. It looks for clearer skies, and still the planes keep flying. This is the illusion at the heart of the crisis. Movement continues just enough to mask the strain. Operations persist even as the foundation weakens. The industry appears stable until it is not. Because there is a threshold, a moment when delayed maintenance becomes deferred safety, when postponed expansion becomes permanent retreat, when resilience becomes exhaustion. At that point, recovery is no longer technical, it is political. What unfolds next is not merely a debate about aviation policy, it is a question about how nations balance control with confidence, how they protect sovereignty without choking the systems that sustain growth. And as financial borders harden beneath open skies, a deeper reckoning approaches. If control over money can ground an industry that is visibly thriving, what other sectors might already be flying on borrowed time? The consequences do not announce themselves with headlines. They arrive quietly, filtering into daily life. For passengers, the first signs are subtle. A familiar route disappears from the timetable. A direct flight becomes a connection. Fares rise not sharply, but steadily. Just enough to be noticed, not enough to be explained. What was once routine becomes conditional. Connectivity begins to thin. For traders and small businesses, the impact is sharper. Time-sensitive goods miss markets. Perishable cargo loses value. Regional commerce, already fragile, absorbs another invisible cost. Aviation, once a bridge between opportunity and excess, starts to resemble a toll gate. And for workers inside the industry, engineers, cabin crew, ground staff, the uncertainty cuts deeper. Expansion promised new jobs. New routes meant stability. When growth stalls behind financial barriers, confidence erodes. Planning a future becomes difficult when the present is governed by delay. These are not abstract effects. They are lived realities. Yet the deeper shift unfolds at the political level. As aviation strains under restricted cash flow, it forces governments into an uncomfortable spotlight. What was once framed as a technical or temporary measure begins to reveal its strategic weight. Decisions about capital controls no longer affect only balance sheets. They reshape national credibility. Aviation becomes a mirror. It reflects how a state relates to global systems, how it balances protection with participation, how it interprets sovereignty in an interconnected world. For years, growth has been measured in volume, passengers carried, routes added, aircraft acquired. But volume without autonomy exposes a vulnerability that numbers alone cannot conceal. When revenues cannot be freely accessed, growth loses its power to transform. This is where the debate shifts. No longer about planes, no longer about airports, but about agency. Across the continent, conversations begin to change in tone. Development is no longer discussed only in terms of aid or access, but in terms of control. Who sets the rules? Who holds the keys? Who decides when money moves and when it does not? In this context, aviation becomes symbolic. It is one of the few sectors where the contradiction is visible to all. Planes crossing borders, while money remains confined within them. Some leaders are beginning to frame this tension more openly, not as defiance but as recalibration, not as isolation but as rebalancing. The language of dignity, self-determination, and economic sovereignty gains traction, not as rhetoric but as response. It is within this wider continental mood that figures such as Ibrahim Traoré are referenced, not for specific policies in aviation, but as part of a broader wave questioning inherited constraints. A generation of leadership and public discourse is asking whether independence without financial autonomy is independence at all. This is not a call for withdrawal from global systems. It is a demand for fair participation within them. The political cost of inaction grows clear with each passing month. Restricted aviation does not remain confined to the skies. It slows tourism, it weakens regional integration, it signals uncertainty to investors watching from afar. And markets are attentive listeners. When capital senses hesitation, it recalculates. When predictability fades, opportunity migrates. The loss is rarely dramatic, but it is cumulative, compounding quietly over time. The irony is sharp. At a moment when Africa's demographic and economic potential is drawing unprecedented global attention, one of its most strategic connective sectors is constrained by rules that limit its own success. Growth exists, but it cannot fully circulate. Promise is present, but it cannot fully convert. This creates a dangerous equilibrium, not collapse, but stagnation, not failure, but frustration. And stagnation, history suggests, is where trust erodes fastest. The question facing policymakers is no longer whether aviation matters. That has already been answered. The question is whether control can be exercised without undermining the very systems that enable growth, because when the skies are open, but the economy remains grounded, a nation must ask itself a difficult question: is protection preserving sovereignty or quietly shrinking it? As these consequences ripple outward, from passengers to politics, from runways to reputations, attention begins to shift beyond national borders. And outside the continent, the world is already recalculating what this moment means. Beyond national borders, the signals are already being read. In foreign capitals, African aviation is not analyzed as a transport story alone. It is interpreted as a measure of alignment between policy and practice, between growth and governance. Connectivity is watched closely, because connectivity reveals confidence. Regional institutions have long recognized this. Frameworks for liberalized air travel were designed to knit the continent together, to replace fragmentation with flow. On paper, the ambition is clear: open skies, integrated markets, shared opportunity. In practice, progress has been uneven. Commitments exist. Implementation hesitates. What holds it back is not demand, it is trust. International partners, airlines, financiers, insurers approach the continent with calibrated optimism. They see expanding populations, rising mobility, untapped routes. They also see capital controls, repatriation delays, and policy unpredictability. The calculation becomes cautious. This is how aviation slips into geopolitics. When revenues are constrained, partnerships are reassessed. Code shares expand selectively. Fleet financing tightens. Long-term commitments wait for clearer signals. No press release announces this shift. It happens quietly, through altered risk models and revised assumptions. Governments abroad respond in measured tones. Statements emphasize concern for connectivity, for market stability, for mutual benefit. The language is diplomatic, the implications are not. Aviation, once a neutral bridge, becomes a data point in broader assessments of economic openness. At the continental level, the dilemma sharpens. Integration promises scale. Control promises security. Balancing the two requires coherence, and coherence is difficult when national pressures pull in different directions. Some states prioritize reserve protection. Others push for liberalization. The result is a patchwork sky, open in places, restricted in others. Airlines navigate this landscape carefully, aware that a route approved today can become untenable tomorrow. In this context, the conversation widens. Aviation is no longer discussed solely as infrastructure. It becomes a proxy for sovereignty. How much control a nation asserts, and at what cost? The debate mirrors a larger continental reassessment, visible in how countries frame trade, currency, and partnership. This is where Burkina Faso enters the international narrative, not as an aviation case study, but as part of a broader pattern. A group of nations is questioning inherited arrangements, weighing autonomy against excess, and redefining what participation in the global economy should look like. From the outside, observers do not ask whether Africa wants connectivity. That answer is clear. They ask whether the rules governing that connectivity will stabilize or harden further. Because capital follows clarity, and clarity once lost is slow to return. For airlines, the stakes are immediate. For investors, they are strategic. For governments, they are reputational. Each delayed transfer, each unresolved restriction adds another layer to the story the world tells itself about risk and reliability. Yet the moment is not fixed. International systems respond to signals. Policy shifts recalibrate expectations. Confidence, once restored, compounds quickly. The same skies that transmit uncertainty can also broadcast reform. The question now facing African aviation is not whether the world is watching. It is what the world will see next. Because beyond the terminals and the tarmac, a larger geopolitical judgment is forming. One that will determine whether Africa's growing skies are read as an invitation or as a warning. The future of African aviation will not be decided in the sky, it will be decided on the ground, where policy meets purpose. The risks are already visible. If capital remains trapped, growth will continue to look impressive while becoming increasingly fragile. Airlines can endure pressure for a time, but not indefinitely. Deferred maintenance becomes delayed renewal. Paused expansion hardens into retreat. What was once a temporary constraint risks becoming a permanent ceiling. This is the danger of half-flight, moving but not advancing, operating but not transforming. Yet the same forces that threaten the sector also reveal a path forward. Because the solution is not technical, the aircraft are capable, the demand is real. The routes make sense. What is required now is alignment between financial systems and economic ambition, between regulation and reality. Aviation thrives when rules recognize movement as value. Reforms that allow predictable access to earned revenue do more than stabilize airlines. They restore confidence across the ecosystem. Lessors commit longer. Insurers reassess risk. Investors return not out of charity, but out of calculation. When money moves, trust follows. There are signs, quiet, cautious, incomplete, that this understanding is taking root. Conversations around regional integration are sharpening. Financial coordination is no longer discussed as an abstract ideal, but as a practical necessity. The idea that connectivity is a strategic asset, not a privilege, gains ground. This is where the metaphor shifts from borrowed wings to owned skies. An aviation sector grounded in financial sovereignty does not isolate itself from the world. It engages it on clearer terms. It trades access for reliability, growth for stability, volume for value. The opportunity is continental. Aviation can become the backbone of African integration, not only by moving people, but by moving confidence. By shortening distances, not just between cities, but between policy intention and economic outcome. The question is whether this moment will be seized, because history shows that when constraints persist, adaptation follows, but not always in desirable ways. Routes bypass restrictive markets, hubs emerge elsewhere. Connectivity reorients itself toward the certainty. And once lost, position is difficult to reclaim. The choice, therefore, is not between control and openness. It is between short-term containment and long-term capability, between holding revenue still and allowing it to work. In the end, aviation reflects the choices of the systems beneath it. When those systems trust movement, flight flourishes. When they fear it, even the busiest skies grow thin. Africa's aircraft are already in motion. The engines are warm, the runways are clear. What remains unresolved is whether the path ahead will open fully or narrow, just as the horizon comes into view. Because this story has never been only about planes. It is about whether a continent ready to rise will also allow its value to move. And that question leads us to the final reckoning, where growth, sovereignty, and hope converge. In the end, this story circles back to a simple truth. Aviation is never just about aircraft. It is about choice. It is about whether growth is allowed to mature into strength or forced to remain performative, visible in the sky, constrained on the ground. Across Africa, planes continue to fly, passengers continue to board, demand continues to rise, But without financial freedom, movement alone cannot deliver transformation. This is why the question before African aviation is larger than schedules or fleets. It is a question of sovereignty in practice, not theory. Of dignity measured not in speeches, but in systems that work. When revenue cannot return home, development stalls quietly. When capital is immobilized, confidence erodes invisibly. And when confidence fades, opportunity does not wait, it relocates. Yet history also shows something else. Moments of constraint often precede moments of reckoning. Across the continent, voices are growing clearer, not louder, clearer. The language of dependency is giving way to the language of agency, of partnership over permission, of trade over restraint. In that broader continental awakening, figures such as Ibrahim Traoré are referenced not as solutions, but as signals, symbols of a generational insistence that sovereignty must be operational, not symbolic. This is not about rejecting the world. It is about engaging it on fairer terms. From Burkina Faso to coastal hubs and regional crossroads, the same lesson repeats itself. Growth without control is fragile, but control without vision is limiting. The future belongs to those who can align the two. African aviation stands at that junction now. The skies are open. The demand is real. The horizon is close. What remains is the decision to let value move as freely as people do, to trust that confidence compounds faster than fear, and that sovereignty, when exercised with clarity, strengthens rather than shrinks possibility. Mention Ibrahim Traoré again, and the point becomes clearer still. This is not about one leader or one nation. It is about a continent redefining the terms on which it rises. If aviation can fly with financial freedom, it can become more than transport. It can become proof that Africa's growth is not borrowed, not conditional, and not trapped. It is owned. If this story resonates with your sense of dignity and direction, stay with us, share your perspective, and remain part of the conversation as Africa charts its own course across open skies and open futures. Because the next chapter is already forming, and it will be written in motion.